I just asked for the correct pronunciation, but it's not so easy. And she will talk about financial risk management for cryptocurrencies, a quantitative analysis. So I think it's a very broad and general review on many things on price dynamics and etc. for cryptocurrencies. So please, Eline, go on. You can share your screen.
Okay, hi everyone. My name is Eline. I hope you can see my screen good.
Yes.
Okay,
yes.
And my slides. Okay, perfect. So as Gianna kindly introduced me, I'm indeed going to present financial risk management for cryptocurrencies. And it is indeed going to be a rather broad overview of all the quantitative risks that occur in cryptocurrencies. Actually, our paper that we are going to present here today is a part of a book we wrote in collaboration with Professor Wim Schoutens from the KU Leuven and two of persons from the Joint Research Center in ISPRA of the European Commission. Because last year I had the opportunity to do an internship at the European Commission, and these wonderful people, Petracco and Lucia, Alessi, were very kind to help me write this book and write the papers in the book, and they gave me excellent guidance. So the whole book is a rather broad overview of all the financial risks in cryptocurrencies, going from qualitative risk to quantitative risk to portfolio management and a little bit more of a broad analysis. But as I mentioned today, we are going to focus on the quantitative aspects of the risks. And therefore, we will start by analyzing the correlation between cryptocurrencies and other assets. And mainly, we want to investigate if cryptocurrencies can be used as a differentiated risk reducer in portfolio analysis. And to do this, the correlation with other asset classes needs to remain below 20% in absolute value. Then we will move on to distributional properties. And in this section, we mainly want to estimate or fit one of the standardized distributions to cryptocurrencies' log returns. For standardized distributions, I mean the T distribution, the Cauchy distribution, normal distribution. You will see in a minute which distribution fits best and why. Then I will move on to the volatile behavior of cryptocurrencies, and this is very broad. As you all know, cryptocurrencies are very volatile assets. For example, at the end of 2017, Bitcoin had a value of nearly $20,000. While only 1 year later, this value was divided by 4 almost. So this is a huge difference in price, and this was only achieved in 1 year. And to investigate this volatile behavior a little bit further, I am going to fit an Armaguard model to the log returns of Bitcoin. And hopefully this Armaguard model will give an accurate value at risk prediction. And then to end my presentation, I will give you a broad overview of everything we've seen here. Okay, so as I mentioned, we will start with the correlation between cryptocurrencies. And we will first look at the situation in 2016 here. And as you can see, the market had a rather low correlation. The cryptocurrencies were not that correlated, except for Bitcoin and Litecoin, here represented by the ticker BTC and LTC. The reason that these cryptocurrencies were highly correlated was because they had similar characteristics. Litecoin is actually an improvement or attempts to be an improvement of Bitcoin. It improves, for example, the transaction speed. And all of the other currencies, as you can see, they were not correlated. But if we move through time to 2017 and then 2018, we see that the market becomes more and more intercorrelated over time. So not only the cryptocurrencies with similar characteristics are correlated, but the whole market seems to move as a whole. One possible reason for this is that cryptocurrencies or other cryptocurrencies are often bought with Bitcoin or Ether, which is the currency of Ethereum. And because other cryptocurrencies are bought using these two currencies, the whole market relies on their price, and therefore the market is so intercorrelated over time. Now, the exact opposite, well, not the exact opposite, but something of the opposite has happened with the correlation between cryptocurrencies and other asset classes. I have here depicted 3 different asset classes. The first is the currency, which is represented by the euro-dollar exchange rate. Then we have gold, which could represent the commodity. And then I have the S&P 500, which represents the equity asset class. So as you can see, the blue one is the 10-day moving correlation. And this fluctuates in all 3 of these asset classes fluctuates around 0. So this indicates that there is not a clear correlation over time. And if we then move on to some kind of a broader window to calculate the correlation between the other asset classes and Bitcoin, for example, the 110-day window, which is depicted in green here, then we see that it is always very, very close to 0, and it never exceeds 20% in absolute value, which is an indication that indeed cryptocurrencies can be used as a differentiated risk reducer, which has a lot of nice properties if you want to use cryptocurrencies in your portfolio, because this means that if a price of any of the other assets in your portfolio moves, it does not mean that the price of Bitcoin will move in the same or a different direction, which is a very nice property to add to your portfolio. Okay, now we will move to some of the distributional properties of Bitcoin. Let's first look at the figure on the left here. This is the time series of Bitcoin over time. As you can see, there are periods where large returns of cluster together and smaller returns cluster together. This could be an indication that the log returns of Bitcoin exhibit volatility clustering. And then if we look to the figures on the right, these are the QQ plots of cryptocurrencies. And all of these QQ plots of are different cryptocurrencies, Bitcoin, Monero, Ethereum, and Ripple. They exhibit fat tails. So now we know that if we want to fit a standardized distribution to the log returns of Bitcoin or any other cryptocurrency for that matter, we have to look for a standardized distribution which can deal with these fat tails. So I came up with all of the different standardized distributions that I could think of, and I estimated the correct parameters for each of them using the maximum likelihood estimation procedure. And then I plotted them on the figure here. And as you can see, there are only 2 that really are good to fit the log returns of Bitcoin, namely the T distribution and the Cauchy distribution. And this is also confirmed by the Kolmogorov-Smirnov test. This says indeed that these 2 distributions offer a good fit for the log returns of Bitcoin. And then to select one of them, we used the Ikaiki information criteria or the Bayesian information criteria. And then the best fitting distribution for the Bitcoin log returns was the T distribution. I repeated this same process for the log returns of Monero, Ethereum, and Ripple. And I came to the exact same conclusion, namely that the T distribution
Io ho perso l'audio. I have lost the audio. I don't know.
Oh, is my audio gone?
At least for me, but maybe it was just my problem. I don't know. I was asking the audience. But
okay.
Paolo, essentially. But you can go on. Now it's fine. You can.
Okay, maybe it was my internet connection.
Yeah. Okay, it's fine.
Okay.
Go on. Sorry.
No, it's no problem. Thank you. So, as I mentioned, cryptocurrencies are extremely volatile, and this plot that I have depicted here is an example of this volatile behavior. If you compare 4 cryptocurrencies over time with other asset classes like gold, the euro-dollar exchange rate, the FIX, which is a peer index for the S&P 500, and it is actually something we use as a standardized volatility measure or a commodity index. If we compare these volatilities to the volatilities of cryptocurrencies, we see that the volatility of cryptocurrencies is nearly 10 times as high as the volatility of normal assets. And this is another indication that indeed this volatility is something we have to take into account if we want to accurately model the behavior of cryptocurrencies. And as I mentioned before, cryptocurrencies also exhibit volatility clustering. But if we want to accurately fit a model to the log returns of cryptocurrencies, we have to map all of the characteristics. So what have we seen so far? We know that cryptocurrencies have fat tails, that they are extremely volatile, and that they have volatility clustering. And then to investigate this behavior a little bit further, we used the long-run dependency with the Hurst parameter as an estimate of this. And we found that cryptocurrencies are also mean reverting. And they fluctuate heavily, as I mentioned before. And these two characteristics together is called anti-persistent behavior. So the best fitting model that takes into account all of these characteristics is an ARMA-Gauge model, where we need all of the 3 parts. The autocorrelation part is depicted here on the graphs below. We need this part because, as you can see, there is some autocorrelation in the log returns of Bitcoin. And the moving average part is also necessary to incorporate the shocks that happen in the past and they might go through to the future. And then the gauge part is especially necessary because this corrects the ARMA part for the assumption of the ARMA part, which says that the volatility is constant, which is absolutely not the case. And then to correct for the fat tails in our distribution, we use the T distribution to the error term, because the T distribution, as mentioned before, was the best fitting distribution. And then we use this again here in this gauge part to model the behavior of the log returns. And then we found the ARMA 2.2 gauge 1.3 model was the best fitting model. Now we have investigated how many parameters were necessary to model the log returns of Bitcoin correctly, and 2.2 and 1.3 was found the best fitting number of parameters by the AYC and BYC, so the Ikaike information criteria and Bayesian information criteria together. So that's why we used both of them. Now we wanted to know if our model was indeed specified correctly. So we wanted to know if we got rid of the autocorrelation and some of the arch effects. And the first thing we noticed was that indeed both parts, so the autoregressive part and the moving average part, were absolutely necessary, because this phi2 term is highly significant and this theta2 term is also highly significant. And then for the gauge part, we also saw that several parameters were highly significant. Moreover, if we take the sum of these 4 terms here, then this is actually equal to roughly 1. It is, I think, if I remember correctly, equal to 0.994. And because it is so close to 1, this is another indication that the log returns of Bitcoin are extremely volatile. Now, we wanted to know if this model was indeed correctly specified, and therefore we used 2 tests, the Leung-Box test for autocorrelation, which has the null hypothesis of there is no autocorrelation left, and this hypothesis could not be rejected, so therefore we assume that the model has no autocorrelation left. And then we used the ARCH-LM test to see if there were no arch effects left, which was also the null hypothesis. And again, we found that the null hypothesis could not be rejected, and therefore we concluded that our model was correctly specified. Now, one of the nice things about the ARMA-Gauge model is that you are able to make a value at risk prediction. This value at risk prediction is very easily done using the model with a window of the historical prices. And this is a result in graphical terms. As you can see, there are 3 breaches, like here, here, and here. And for the remainder, our value at risk works actually perfectly. And because there were only 3 breaches, we can say that our value at risk prediction indeed is a good fit, and it can be used to do risk analysis. Now I will go over everything that I have talked to you in the last 15, 10, 20, I don't know, minutes. So the market of cryptocurrencies is extremely correlated, and Bitcoin and somewhat Ethereum have a leading position because other cryptocurrencies are bought using these 2 coins. And that's also the reason why the market is so intercorrelated. Cryptocurrencies offer a nice advantage because they are a differentiated risk reducer, and therefore they are very handy to use in portfolio management, mainly because the correlation with other asset classes remains below 20% in absolute value. Cryptocurrencies exhibit fat tails and have a high kurtosis, so the normal distribution would never fit to these returns. We found actually that the T distribution was the best fitting distribution to these log returns of Bitcoin, Ethereum, Monero, and Ripple. So not only for Bitcoin, but for 3 other cryptocurrencies as well. And then for the volatile behavior, we found that cryptocurrencies exhibit volatility clustering, and they are mean reverting and very volatile. And this highly volatile nature plus mean reverting is called anti-persistent behavior, which we have proven using the Hurst parameter. And then lastly, we fitted an Arma-Garch model to the log returns of Bitcoin. Our model was specified correctly by a number of terms, and this Arma-Garch model has the nice advantage of using it for a value at risk prediction. If you want any more information or if you have any question, please ask and do not hesitate. Thank you so much for listening.
Okay, thank you, Eline. And you were on time, even you finished even before. So I ask if there are questions from the audience.
Should I stop sharing my screen or not?
Not yet. Let's wait a little bit if there are some questions. And so I don't see any raised hand. I have a question indeed myself. So I have been myself studying a little bit the dynamics of mostly Bitcoin, and I was I was wondering whether the models that you have fitted, the ARMA 2.2, GARCH 1.3, etc., the results you have shown are the results for Bitcoin, no, isn't it? Yes. And have you fitted the same model, or just for the other cryptocurrencies, are the results consistent, or?
For other cryptocurrencies, I haven't fitted the Arma-Garch model because when I did this analysis, the returns of other cryptocurrencies were not reliable. So I wasn't able to do an accurate test with them. Because at the time, I think it is now, it wasn't this year, but the year before I fitted this model.
Sorry, the data goes from, because in the first part of the talk, you were dealing with many different cryptocurrencies. So this is the reason for my question.
Yes.
And, so you fitted the model, which was the period in which you fitted, because I got kind of similar choices, but it was a little bit different, let's say the overall setting, because I had some external also exogenous factor in the Garch equation, etc. And I was only using the, let's say, the normal distribution, so the standard Garch modeling. But I find, of course, the similar ARMA 2.2 as the best fit in the mean equation. So I was just wondering whether these results was consistent with other cryptocurrencies, because, but I don't see so the data you used, because in the previous analysis, you were considering Bitcoin, Ethereum, etc. until 2019. So I also thought that this fitting was to recent data.
Yeah, the whole book uses the same set of data, but because this analysis for the Armagarch model was so lengthy, I only did it for Bitcoin and not for the other cryptocurrencies, while the fitting of the t-distribution was much faster, and I just had to change a parameter and it does the whole thing for me.
If you want to go on with the research, it can be a good idea, because as you said,
indeed,
some years ago, Bitcoin was the main cryptocurrency somehow. Now we have a lot of them, and maybe also Ethereum is a kind of benchmark to be considered. So
yes, that's a very good suggestion. Thank you.
Are there any other questions? Let me see in the chat. No, it's just Paolo asking. Okay, so I think that we can move to the next presentation, which is by Thomas Joubert, and from the laboratoire I've written here, Laboratoire d'économie mathématique et de microéconomie appliquée.
Perfect.
Hello, Thomas.
Hello.
And so the talk will be on the changing nature of cryptocurrencies, an analysis of Bitcoin and its copies during their clonings. So the floor is yours, and I will just have the timer here. Okay.
Okay. Let me first try to share my screen.
There should be, yes. Okay, perfect.
Does it work?
Yes, it's fine. It's fine. Thank you.
Okay. So my study is comparable to the one of Eline. I am studying the return of cryptocurrency over the hard forks. The hard forks, let me explain it quickly. When there is an update of the Bitcoin protocol, then there can be some users that do not like it and choose not to use it. In this case, there can be two living versions of Bitcoin at the same time. One version that follows the update and one that does not. The goal of this paper is to measure the impact of hard forks on the price formation of price currency, especially Bitcoins, during the three hard fork I selected. Let me show you which ones. Okay. So the first hard fork happened in the 1st of August 2017, which is Bitcoin Cash. The second one is Bitcoin Gold and happened in the 24th October in 2017. And the third one year later, is Bitcoin SV, and it happened in November 15th, 2018. So why is it important to study the impact of hard forks? The first reason is that hard forks are likely to happen again, and not especially on Bitcoin, but it can happen to most of the cryptocurrency. So many hard forks oblige me to study many studies, because each study must be included into 2 hard forks. The methodology comes from the literature, so I will update their results. So let's switch to the 4 hypotheses I chose. The first one gave the more stable results. It measures the impact of the attention curve by each cryptocurrencies. Christopher, for example, did it the first in 2030. He used the consultation of the Wikipedia page of Bitcoin and Google Trends. The financial markets gave more variable results. Sometimes it is measured to have an impact and sometimes not. My first hypothesis is an economic reasoning derived from Barrow. In this equation, you can see the price of Bitcoin, that is a function of the interest rate, the money supply, the price level of the economy, and the quantity of goods that are exchanged for cryptocurrencies. So basically, the interest rates and the money supply are expected to have a negative impact on the price of Bitcoin, while the price level of economy and the quantity of goods that are exchanged for cryptocurrency are expected to have a positive impact on the price. In general, such a reasoning has not been successful in the literature. Finally, I have a fourth hypothesis that I did not take from the literature. It's supposed to measure the competition between each version of Bitcoin. Basically, we can expect the version to be competitors because the very existence of cryptocurrencies is the result of a conflict, or we can expect all cryptocurrency to be the part of a big market of cryptocurrencies, so they could be substitutes. My economic approach is also comparable to Eline. But first, I need to delimitate the periods of study. So it takes into account two things. First, as I said in the introduction, it must be included between two hard forks. And to delimitate precisely the period, I use two algorithms designed by Shaw and Fulvia and Shaw in 2014 and 2016. These two algorithms have several advantages. One of them is that it allows to detect more than one breakpoint date, which is usually the case, for example, in the Zivot-Andrews test. And it is also designed not to detect too many breakpoint dates. This is why I chose it. After I choose a period, I will estimate the result for all the cryptocurrencies that existed at that time, plus Ethereum. This is a diff-in-diff approach. This means that, for example, if I detect a change in the nature of Bitcoin, but I do not detect it on the nature of Ethereum, then it probably means that the change is due to the hard fork. I chose Ethereum because it existed in 2016, which is the beginning of my period of study. We must remind that in 2016 there were much less cryptocurrencies than today. The functioning of Ethereum is comparable to the one of Bitcoin. And finally, the importance of Ethereum has remained stable over the last few years. Just like Eline, I estimate the daily return in dollar of cryptocurrency. However, I use, when it is appropriate, linear regression. It is important to have the same model in all over the study, but most of the variables were not stationary at each period of study, so I could not use models such as vector error correction model, for instance. When it is, moreover, there are sometimes very volatile periods over the cryptocurrency markets. So there can be some heteroscedasticity. And in that case, if I detect some Garch models, then I can turn my linear regression to Garch model. Finally, quick look at the data I will use. For the attention hypothesis, I will use the Wikipedia page views of the relevant cryptocurrency. I use it both in English only and in all the translations that exist. What we must remind about that is, for instance, the Wikipedia page of Bitcoin exists in like 100 languages, while the Bitcoin Gold page exists only in 8 languages. So I also use the new subscribers on the Reddit forum. Regarding the financial markets, I use 4 stock exchange indexes, which are the SP 500, the Eurostoxx 50, the FTSE and the Nikkei, and also their volatility index. I also use 2 exchange rates that are the USD GBP exchange rate and the USD Euro exchange rate. Finally, for the economic hypothesis, I consider the price level of the economy to be stable because the period of study are quite short. And I use the number of active addresses and the number of transactions to proxy the number of goods that are effectively exchanged for cryptocurrencies. The money supply is provided by the blockchain itself, so it does not need proxies. And I use the US Treasury rates to proxy the current interest rates. So hypothesis by hypothesis, the results are the following. Okay, no. Let's first start to the period of study. Here are the detected breakpoint dates that are detected by the algorithm of Shaw. The first thing we can see is that the break data detected are not necessarily close to the hard fork dates. So this already suggests that the hard fork does not have the most impact in the change of nature of the cryptocurrency I study. Here are the 5 periods I will study. For each period, there are 1 new cryptocurrency, except for period 3, because I splitted it in 2 sub-periods. Because I detected a lot of breakpoint data in that period, this test has been confirmed by the Zigot-Andrews test. So sub-period 3A must be compared to observe the change in nature of Bitcoin and Bitcoin Cash after the Bitcoin Gold hard forks, while period 3B is supposed to observe the change before the Bitcoin SV hard fork. So the results are the following. Let me first explain how to read this table. For each period and each cryptocurrency, it provides you the variables that are found to be significant to explain the price variation of cryptocurrencies. You have in parentheses the number of views of Wikipedia or the number of new subscribers necessary to explain a 1% change in the price of Bitcoin. So for instance, in period 3B for Bitcoin Cash, 4,300 views on the Wikipedia page were required to explain a 1% change in the price of Bitcoin Cash. So what we can observe, and also the D before the variable means that the first difference is found to be significant. So in this case, for example, Bitcoin needed to obtain 32,000 views more than the day before to explain a 1% increase in price. So what we can see quickly is period 3A was particularly sensitive to the intention code by cryptocurrencies. Oh, sorry, and in blue you have the R square. But this fact is also true for Ethereum, which is used as a control cryptocurrency. So we can see that there are changes in the natures, but there is nothing that shows that let us think that it is because of hard fork, especially because between period 3A and 3B, there were no hard fork. But there are indeed a change. Let's switch to the financial market hypothesis, which is quite fast because it gave almost no results. There are no periods in which financial markets are relevant to explain the change in price of cryptocurrencies. So let's switch to the next hypothesis, which is the economic hypothesis. Now you have the coefficient in parentheses, otherwise all the interpretation must be the same. Here again, you can have you can observe some change in the nature, but also between period 3A and 3B. So nothing let us think that it is because of the hard fork. Moreover, we can see that Bitcoin Cash is a little bit better responding to the economic hypothesis than the other cryptocurrency, which suggests that it is the least bad choice to use as a mean of payment. Finally, the fourth hypothesis studies the competition between cryptocurrency. Basically, the results are completely in line with Eline, because in 2017, then we can find that the return of cryptocurrency does not explain very well the variation between them. But over time, it's become better and better linked. The interpretation could be that there can be a period of conflict to cross when there is a hard fork, because I remind that a hard fork is a conflict or is a disagreement. But after a certain time, each cryptocurrency becomes closely correlated. As a robustness check, I also test the 4 hypotheses on the Ethereum hard fork of 2016, which gave also changes, but all the changes I detected were not the same than I detected with Bitcoin. So I did not put the financial market because it was not significant at all. So to conclude, we can see that the nature of cryptocurrency are changing over time, but we cannot attribute it to the hard forks. The economic hypothesis is a little success, while the financial market has no success at all, which means that Bitcoin could be used as a diversifier rather than as a mean of exchange. And finally, the cryptocurrencies that are issued from hard forks can have a period of conflict, but over time, when time is spending, there can be substitutes. So what remains to be done by the research is to find what does provocate these changes, and it is not easy to answer this question. Thank you for your attention, and I'm very welcome to hear for your remarks and your questions.
Okay, thank you, Thomas. And so I'm just asking again if there are questions on Thomas' talk.
Where is the hand? I cannot find the hand.
There's no hand for us. Me too, I don't find any hand, but you can ask a question.
Okay. I wondered if the fact that the cryptocurrencies probably experience a lot of algorithmic trading, if this phenomenon has any impact on the results, because algorithmic trading usually creates very persistent patterns. So hard forks or not, those high-frequency participants really dominate everything, regardless of the real factors that may intervene. So is it so, or have you noticed anything?
Yes, that's it.
So Thomas, is the question clear to you?
Not really. In fact, I did not hear it very well because of the quality of my connection.
Oh, I see.
Alexis, yeah, can you repeat?
Okay, the algorithmic trading, does it enter your analysis? And does algorithmic trading change, in your view, what happens around the hard forks?
Okay, sorry, can you repeat it just one more time?
Well, the keyword, algorithmic trading, AT. Probably I can write it.
He's asking, is the algorithmic trading, so there are bot trading somehow in cryptocurrencies, etc., may affect somehow your results. I don't know exactly. So
yes, this is a piece that you could use. I did not use it yet, but I will think about it.
So you could investigate whether there's this algorithmic trading may affect. So, but Alexis, you were talking about high frequency data. So which is the frequency of the data you were using?
Daily.
Thomas?
I was using daily data.
Daily data. So, okay, daily data. Okay, are there any other questions? I have a question. I am quite interested in how attention is important in these markets. I have also addressed this issue before in some research. And I was just, since we have a little bit ahead of time, can you detail a little bit how exactly, I haven't understood very well, how did you use test for this attention? How do you attention enters exactly in your problem? So I don't know if you can share your slides again and go to the table where you were mentioning about the attention hypothesis. So it's not clear to me what is exactly that, what exactly you are doing in this table. Can you just?
Yeah, I will try
so
to make it more clear.
Of course, I can have a look at the paper, but I mean, we are ahead of time, so we can somehow share also with us.
No, and I'm taking your remark with interest, so I think it is good for me to try to explain it better. Let me switch. Okay, it was this slide?
Yes, yes.
So, yeah, I try to make it clear, but you have in parentheses the number of views that are required to justify a 1% change in price of, for instance, Bitcoin Cash during period 3B.
Okay.
And the number of views of the Wikipedia page explain 3% of the variation of price.
Okay, so here we read that the 4,300 are the number of views on Wikipedia during that period, and then they're explaining 3%. This is the.
This is what is required to explain a 1% change.
Okay. 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 Thank you. Now it's more clear. Okay. Thank you very much.
Thank you.
So, are there any other questions from the audience?
I have a small question.
Yes.
So now you have shown that indeed the interest in the Wikipedia pages influences the price. But do you also believe that the price influences the number of Wikipedia visits? Because as you can imagine, when the price of Bitcoin was so high, that a lot of people visited the Wikipedia page to investigate what is happening here. So do you believe this is true as well?
Yes, I think it is definitively true. But to investigate about the cross impact of the two variables, you need to use models such as VAR model or vector error correction model. But you cannot use it because the variables are not always stationary. So I believe it does have an impact, but I cannot use a multivariate model.
Okay, thank you.
There is an important, let's say, contribution in this direction, which is what causes the attention of Bitcoin, but Andrew Urquhart, which is somehow studying exactly with these vector autoregressive models, the causality direction between attention and cryptocurrencies and the other way around. Yes, and indeed, many times it's kind of bidirectional.
Okay, I will look into this. Thank you.
Yes, thank you for your question.
Okay. Are there any other questions? Well, if not, I can, so I can just say thank you very much for your presentation to Thomas, and just go on with the presentation of Fulvia Pennoni, which is our third speaker today.
Hello, everybody.
Please. Hello. Hi, good morning. Say good morning. It's afternoon already, but anyway. Okay, then, so Fulvia, she's at the University of Milano-Bicocca, so somehow she's an insider in this conference, and she will talk about multivariate hidden Markov model for cryptocurrencies. So again, you have about 22 minutes and you can go on, okay?
Okay, thank you. And I should say that this is a joint work with Bartolucci from University of Perugia, Forte and Milano from University of Milano-Bicocca. So the presentation is scheduled in a brief introduction to the problem I will explain, and I will show you some notation that we are using for the proposal, which is a multivariate hidden Markov model. Then I will highlight some maximum likelihood estimation of the model parameters, and I will show you the results of the applicative example where we use the log returns of 5 cryptocurrencies. And then I will highlight some conclusions. So first of all, I should say that this class of models is called multivariate hidden Markov models, and it is a statistical as well as an unsupervised machine learning method, and it is very used to analyze financial assets price series. And the reason is mainly that it is a flexible framework in this field, and also it allows us to incorporate stochastic volatility in a rather simple form. So with respect to the regime switching models, the HMM is able to provide estimates of state-specific expected log returns along with state-specific volatility. Mainly estimation and prediction of the volatilities based on the expected log returns, which are considered as well as parameters to be estimated from the model. So in this presentation, we are considering the correlation structures between crypto assets, and what we do is to model as well the daily log return of each cryptocurrency, and to assume that is generated by a specific probabilistic distribution which is associated to each hidden state. So we account for the conditional means, and we define the expected log returns, and we show that they can improve time series classification. In fact, we can say that stable periods, crisis, as well as financial bubbles differ significantly for mean returns as well as for structural levels of covariance. Here I will introduce some notations. So let yt be the random vector at time t, and let ytj be the corresponding the corresponding log return for asset j. So we assume that these random vectors are conditionally independent given an hidden process, which is denoted by U1, U2, and this hidden process follows a Markov chain having a finite number of states or regimes, which we label from 1 to k. So in these settings, we are modeling the conditional distribution of every vector yt given the underlying latent process ut, and in this setting we assume for simplicity first of all a multivariate Gaussian distribution. So the conditional mean of the observed log returns is assumed to be normal, multivariate normal, with a vector specific for the means and a specific variance covariance matrix, which is regime specific. So in this way, we specify a heteroscedastic hidden Markov model. The conditional distribution of the time series y1 and y2 given the sequence of hidden states is expressed as the product of the single density function, and what we can also estimate from the parameters of the model are the initial probability defined in the notation like lambda u, and collected into the vector lambda, and the transition probability defined as pi v given u, and collected into the transition matrix, which is a k by k stochastic matrix. So in this way, we are also estimating the model parameters by using the expectation maximization algorithm, and this aim we have to consider the log likelihood of the model, which can be written in this way. But what it is important is to write down as well the complete data log likelihood. And an important aspect of this estimation procedure is that this log likelihood can be decomposed into 3 pieces. And for example, the first one is L1 star, and it is related to the measurement model. And L star 2 and L star 3 are related to the structural model. So in this formulation, we use dummy variables such as WTU, which is a dummy variable equal to 1 if the hidden process is in state U at time t and to 0 otherwise, as well as Z is a dummy variable for the transition. So I will skip some details just to say that within this estimation procedure, we need to, account for the 2 steps of the algorithm. So the expectation step computes the posterior expected value of each indicator variable WTU and ZTUV given the observed data. At the end steps, what we do is maximize the expected completed data log likelihood with respect to the model parameters, and these steps are iterated until some convergence criterion is reached. So at the end step, the parameters in the measurement models are updated quite simply in this way. I don't go into details, but you can find some more details in the paper, as well as at the end step, the parameters of the structural models are updated with simple forms. So an important feature of this estimation procedure is that we have to initialize the parameters of, and then we do generally this step by considering both deterministic and random starting values. So for the deterministic case, we guess initial values according to sample statistics. When we are using random starting values, they are generated by uniform distribution. Another aspect of this kind of models is to select the appropriate number of regimes, and for this aim, we rely on the Bayesian information criterion, and in this context, we are considering that the Bayesian information criterion for the model with K regimes is given by the log likelihood at the maximum value, which is penalized by these 2 terms, which are related to the number of observation times, as well as to the number of free parameters that we are considering in the hidden Markov model with K states. Another important aspect of this model is that we can perform what we call local and global decoding, and this is to predict the most likely sequence of latent or hidden states, and so the sequence of regimes we are considering. Okay, I'll switch to the application to show you what we have done in this preliminary analysis of this market. So we are, first of all, we considered 5 different cryptocurrencies, which have been selected according to the principle established for the crypto asset lab index. And the reason are that they are reliable, liquid, and less manipulated with respect to the others. So they are Bitcoin, Ethereum, Ripple, Litecoin, and Bitcoin Cash. So another feature is that we are going to use log returns referred to 3 years, starting from August 2017 and to February 2020. I should say also that some computational tools that we implemented for this application have been done by adapted functions which are available on the R package called LMS, which is a suitable library to analyze data with these kind of models. Okay, so in this picture, I'm showing, as you have seen also before, the other presentation also we're working on this series. This is the price of Bitcoin, as well as the daily log returns. So as you can see, we recognize mainly 2 periods of special rise in price, and they are related to the end of 2017 and mid 2019, so here. Of course, we are interested to model jointly the 5 cryptocurrencies. So here we are looking at the observed covariance matrix, as well as we report the observed correlations and partial correlations. So looking at the raw correlations, we can see that they are quite high. Anyway, when we are looking at the partial correlation, we can see also that there are some negative correlations, for example, between Bitcoin and Ethereum, given all the remaining cryptocurrencies. Okay, the first results of our estimation concern the choice of the number of regimes. As I said to you before, this is made by the BIC. So in this table, I report the log likelihood at maximum when we estimate a hidden Markov model with the number of regimes ranging from 1 to 6. As we can see, the best model is selected with k equal to 5 hidden states. So the results I'm going to show you now are related to this model. First of all, the interpretation of the regimes can be gained by the estimated expected log returns. So here we depict, the metrics of the log returns that we estimate with the proposal, and mainly we can, define 3 negative regimes according to the average of each hidden state. And then 2 positive regimes, the last 2, so 4 and 5. Surely these kind of regimes represent the occurrence of a variety of situations which are happening in the market, and mainly we can say that state 1 represents a negative phase of the market, but looking better at state 2 and state 3, we can identify them as more stable phases. States 4 and 5 are related to phases of price rise, mainly. So another interesting information can be gained by looking at the estimated conditional variances and correlations. So in this big table, I report for each state what we have said, the state-specific variance on the main diagonal, and state-specific row correlations below the diagonal, and state-specific partial correlations. So, for example, if we are looking at state 2, we can notice this, of course, high correlation estimated between Bitcoin and Ethereum, and we can see that the partial correlation is negative here. Another important aspect is to detect the risk according to the estimated variances, and mainly we can surely detect state 3 as the most stable between the 5 states, and state 1, for example, represents high volatility in this case. So I summarize briefly some conclusions that we can draw from this table. We can see that state 5 also is the most volatile. State 1 is characterized mainly by significant falls of price and by market volatility. State 1 and 3 are both marked by negative returns, but they show a very different levels of risk. Another important feature is to look at the estimated transition probabilities, and this is the transition matrix. So you can see that there are mainly 3 really persistent states, state 2, state 3, and state 4. And it is interesting to note that there are some transition from each state to the first state. So, persistent state is the 5th, and an important transition is between 5 to 1, sorry. this one. So, of course, the highest estimated transition from the less persistent state 5 to state 1 can be read, for example, as the typical short pullback following a substantial price increase. Okay, I will show you also the estimated posterior probabilities. This graph is related to each state. So we estimated the probability to be in each state, and we overimposed a trend line based on smooth regression. So we can see from this picture that there is a decreasing tendency for state 4 and state 5, and on the other hand, an increasing tendency for state 3. The range, of course, of this probability is from 0 to 1. I summarize briefly also this picture, and we can say that apart for few exceptions, there are not stable periods in the market, as you can imagine, of course. As I told you, we performed also the local decoded, and then in this picture you can see which state is predicted to be visited over the timeline that we are considering. So looking at the decoded states, we can say that state 1 represents negative phases of the market, and it is visited for the 37% of the overall period. States 2 and 3 are representing more stable phases, and they are visited 16 and 32% of the overall period respectively. And states 4 and 5 are related to phases of the market with, a price rising, and are visited less, 8% and 7% of the overall period. Another important, results that we are going to produce with this model is the predicted average and the standard deviations, of course, so that we can predict daily. In this picture, and I just show the average of the hidden Markov model for Ripple, but of course we have done it also for the other 4 cryptocurrencies. So here we can see that the model is able to timely detect regimes of high or low returns and volatility. Of course, it is interesting to compare these pictures across cryptocurrencies. I don't have a lot of time to go into details also for Litecoin, for example, and I skip briefly to the predicted correlations. So I estimate also the correlations of Bitcoin with the other 4 cryptocurrencies over time, of course. You can see that the range here is positive, ranging from 0.2 to 0.8, and it is interesting that, as you've noticed before also on the other presentations, also the model is able to detect this pattern, and there is a medium-term trend of greater correlation relative to Bitcoin, but we can produce the same picture as well, comparing a couple of other cryptocurrencies. I'm going to conclude just summarizing that there are some advantages to employ hidden Markov models in this analysis, and from the results we notice that the model provides quite remarkable prediction of the log returns and volatility for future time occasions, also for each crypto, and mainly we can market that we are interested in jointly. So from the predicted correlations, we notice that there is an increased market correlation over time, and this is coherent with the hypothesis also of a higher systematic risk. Thank you very much. I ended my presentation. So.
Okay, thank you, Fulvia. Thank you very much. A very interesting contribution. And again, I'm asking, are there any questions from the audience and from the other panelists? No? Fulvia, I have many questions, so I won't ask all of them here because I'm really working on something very similar right now, so it's just submitted. And I have told already to Ferdinando once I read your abstract and etc. So I will just ask for one specific question, then maybe we will get the opportunity to talk later. And Francesco is also from my university, so maybe when you come here, who knows, we can have a talk. And my question is only this one. So you are doing the whole thing jointly. So you estimate these 5 regimes, which are somehow forcedly common regimes, isn't it? Yes. Yes. Because I was just wondering, because in my analysis, which is in a slightly different setting, but somehow from a conceptual point of view can be more or less the same thing. So we evidence that we have indeed 4 or 5 individual regimes, but then when you go to common, somehow we find that we have at most 2 or 3 regimes. So as if there are some regimes which are typical of the asset class, let's say, okay, of the majority of cryptocurrencies, while there are other regimes which are more, let's say, individual, no, on each individual cryptocurrency. So even if the technique is kind of different, etc., but maybe this could even improve somehow the predictions, because we are just considering some broad things which are common and are just 2 or 3, and then maybe you are going specifically to each currency. So we didn't go through prediction yet. So somehow I don't know this, but maybe differentiating what is really common and what is more individual would be interesting also in your setting. So, and then maybe we will talk about, okay?
Yes, thank you. Thanks a lot, because the choice, of course, of the regime is not easy, and then we apply them in the RAL of the BIC. But of course, I think that also it would be interesting to read the work you are doing as well, to exchange ideas and to think about, I mean, the best, way to make prediction. This is the aim at the end. Thanks.
Indeed, indeed. Okay, are there any other questions? For Fulvia?
I wanted to ask one.
Sorry?
Yes, I had a question again. I only have an opportunity to shout because there is no hand in this.
Yes, because the hand is for the attendees, and then we are allowed to talk, so you can just ask the question.
All right. Your sample includes the 2017 crypto hype period. Does it mean that the results are significantly influenced by the presence of this particular period? If one started later, for instance, in 2018, sometimes you might have to redefine your regimes completely and just stay outside of all excesses and all bubbly growth episode.
Yes.
Is it so?
Yeah, thank you. Yes, thanks for the question. In fact, we notice nowadays also from the results, big differences between the first period and the other periods. Also, the estimates are providing us with this, evidence. So it would be also interesting to estimate maybe the model without some, without the first observations, and then to think to the differences.
All right, I'm asking because there is a name in one of the presentations, a literature reference to a paper by Christophe, by the way, my former student. He uses wavelet analysis. His study dates back to 2013, 14, 15. He tried to analyze different crypto exchanges and to detect price impulses geographically coming from different parts of the world. What he discovered is that essentially in that period, that was before the 2017 bubble, it was essentially Chinese investors that drove prices of all cryptocurrencies existing at that time. The pictures he presented actually said that it was everything only dependent on what the Chinese millionaires or billionaires decided to do, and all the cryptocurrencies available were treated more or less similarly. So Ripple was even more susceptible to this treatment than Bitcoin or Ether. So I was wondering whether the study like this isn't just illustrating the behavior of Asian speculators, or their moods at the current juncture or during the period you analyze.
Thank you. Thanks a lot for the suggestion, and I will also be happy to receive maybe this paper if you can send me, so I can read it as well. And sure, this is something that should be done with.
I think you can find the reference in the presentation by Thomas that we heard 2 presentations earlier. It's an earlier paper, and the same author is doing more and more on this. In my paper, there is a reference to his later work.
Okay, thanks.
Anyway, just to let you know, of course you know, but maybe the attendees, that all the papers are linked to the names in the program page of the conference. So if you want to see the references and etc., you can just download them from there. Okay, so I think we are going to the last speaker of our session, which just posed the question, is Alessi Stervitz, and he's from the Monetary Department of the Czech National Bank, and he's talking about coexistence of physical and crypto assets in a stochastic endogenous growth model. So please, Alexis, the floor.
Thank you. So after 3 or how many empirical papers, there will be 1 theoretical one. Well, it's not actually a pure theory, because the theory part is pretty standard. The numerical part was less standard when I did it. However, the background of all this is a story or a question that my institution and many other central banks, which I know they are trying to answer, namely whether crypto are here to stay, or is it a temporary phenomenon, something like a fashion or a fad that will just culminate at some point and then recede. So the effort spent on theoretical or policy analysis of crypto assets might, from the point of view of some of my colleagues, wasted on a thing that will not be so hot in a couple of years. Well, this is a minority opinion. The majority opinion is rather that of a panic. People, real fans of cryptocurrencies, pronounce, or what they declare from the very beginning, namely that the traditional finances, the traditional monetary policy is on the way out, because their products will rule the world, and not just central banks, but banking as such is on the way to demise, because their creation is much better than traditional money. So the panic mode is such that one should immediately start analyzing what is going on, and whether there will be a crowding out really of traditional money by crypto coins, or the other way around. Maybe there will be some kind of concentrated effort on the part of key monetary authorities that will simply eradicate the crypto world, and then again this will make the current efforts worthless. Well, my choice was to take a middle way, take some kind of model that is familiar to macroeconomists, macro and monetary policymakers, and try to infuse crypto assets into it and see if they can coexist in some kind of long-term perspective, balanced growth environment, for instance. And so also it's important to figure out whether it is a good or a bad thing in general. Will there be some kind of resource drain, or maybe from our perspective, from monetary policy perspective, if it's action and enhancement, what actually awaits the economy if it is constantly equipped parallel with the traditional and the crypto assets. So the immediate question was how to model it so that the economist community understands it sufficiently. The theory is not very rich at the moment, because indeed, a recent thing, right? Not even, well, about 10 years old. And those theorists who attacked the issue, they, in my view, took the declarations by the crypto fans all too literally. Those fans declared that they presumably had created a currency, so theory started investigating the problem from the currency competition point of view, leaning on the literature that existed, well, 10 or 20 years ago on that topic. And mainly the crypto assets were reduced to cryptocurrencies, so their name was taken literally. That's why they were mainly investigated from their means of exchange side, and not from their, let's say, store of value side. But if one talks about store of value, the usual objection is that cryptocurrencies have no intrinsic value. They are bubbles par excellence. There is a literature on bubbles that can be presumably applied to this phenomenon. Well, then there is the empirical side that is more kind of down to earth, one can say. So people try to identify sources of price movements or really bubble properties from the econometric perspective, or thing that happens to initial coin offerings, to make some sense of what happens on that markets. And there are some fledgling papers on policy, although in recent times most of the effort is concentrated on stable coins, not on the first generation currencies as such. So before I start with the model, I must mention what was the general approach. If one wants a piece of macroeconomic thinking with cryptocurrencies present, why should they be present there? Well, my story will be based on a metaphor by Thomas Hobbes, the 17th English thinker, so it's something invoking philosophy classes of my youth. He was fond of this metaphor concerning the Leviathan. Stated that the powers that rule human societies are like semi-anonymous creatures resembling the biblical book of Job, Leviathan. So it is not a single personality, but some kind of synthetic personality that simply imposes its will on the society. Kind of anonymous ruler that is its will. But I must say that experiences of modern people suggest that this beast is getting older, but it's getting, the beast is also getting more voracious. It consumes a lot of resources. The society becomes more and more complex. So those who earn more than others, they are concerned with the problem of protecting what they earn, and it's getting steadily more and more costly and complicated to protect one's earnings from attacks from all sides, which can be summarized by societal complexity. So this defense against Leviathan is not just primitive tax evasion, it's an attempt to avoid complexity. My story will be a story of escape. There is a physical world, physical investment, production, consumption, and there is a crypto world. There is a gateway between the two, kind of, let's say, collective token representing an abstract crypto investment fund. I am talking about cryptocurrency price here. I'm talking about the price of that token. So through this gateway, a person who thinks that it is better to hide something from the Leviathan can buy those tokens and convert them later. If there are exchanges, if there are people willing to buy those tokens back, then those tokens can be converted back into consumption. So this is a graphic illustration of what I'm talking about. The horizontal axis is absorption. Richer people absorb more, but instead of one-to-one from absorption to consumption, this is the 45-degree dotted red line. There is a reality, meaning that the more you have, the more dead weight loss you suffer from keeping your belongings intact. If you're really poor, close to zero there, then it's the other way around. You have some kind of universal basic income. It's not quite zero. Positive, so you are above the diagonal. Anyway, the incentive to acquire crypto assets exists with people who are on the right half of this line, somewhere where they really have a lot of things to lose if they leave things like they are, and not really much to lose if they risk. Namely, there is a risk to take to acquiring tokens and to live partially your life in the crypto universe, because this is a very lawless environment. Fraud and hacker attacks are rampant, and there are technical glitches. Occasionally there are regulatory crackdowns. So for instance, Chinese investors tell a lot of things about how their crypto exchanges were prohibited, shut down. In the model, it is captured in the following way. You can buy one by one at the current market price. But if you want to convert your crypto token back to conventional consumption units, there is a risky procedure that can cost you some funds. So if you convert huge sums, so it is approximately linear. But if you convert small sums, well, fixed costs start to dominate this conversion. It is really a choice between uncertain wealth creation in your crypto world against the certainty of losses due to Leviathan, due to complexity in the physical world. So pretty standard theoretically, but is not so standard to try to analyze it in a dynamic macroeconomic context and see if possible equilibria include situations in which you balance your life between the two worlds, not abandon one in favor of another, whatever direction. So here are the mathematical things that I probably can skip. If you are interested, you can look at the paper. So something more general about how this model works. Here is a formal summary of what I was just talking about. Your consumption is your physical Leviathanian function n, which is has a decreasing marginal return. So your income y minus investment minus token purchases. So instead of converting it one-to-one to consumption, you have to count on losses. The more you want to consume, the higher the losses are. It's a convex function. Plus something that you add by converting back your pre-existing token possessions into physical goods. P is the nominal market price, and L is the conversion function. It depends on the random parameter L, which tells us if losses are big, medium, or small. So ideally, you have L equal to 1, and then there's a one-to-one conversion, but it's a very rare thing. Huge losses are also rare, less probable. So the typical thing is that you lose a percentage of the S quantity of your tokens, you convert back and want to consume. So the tokens are assumed, since it's really an investment fund, not an individual crypto asset, not a utility coin, it's not a cryptocurrency, it's not a stable coin, it's something diversified. Is outside the scope of the study itself. So there is an internal rate of growth, and the more there are tokens around, the higher this return is. So if people lose interest in crypto completely, then big R becomes 0, and the dynamics of crypto holdings leads to gradual conversion to 0. It turns out that the stable dynamic equilibrium that exists doesn't include such outcomes. There is no complete death of crypto under any adverse circumstance. There is always someone who wants to go on. Then let's say there is a maximization problem. I will only comment upon the optimal decisions of those agents, they have two state variables. They must be normalized because we are talking about the growth environment. So they are normalized by the aggregate physical capital, K with bar. And so if you normalize to account for balanced growth, then gives you with two variables, which is your physical disposable income QN and the crypto possessions X, and also normalized by the aggregate number of tokens in population. And there are three decision rules, three policy functions, all normalize those small small letters H, S, and V are all the result of normalization. The first policy function is responsible for crypto creation. It's when individuals go and buy something in the market. Back conversion S, they convert existing tokens, and then there is physical investment. So more or less like this, if you do the numerics, you receive something of the kind, but there is no space to comment upon the exact. There are lots of stories that can be told based on the shape of those surfaces. I must stress that everything that is happening here is only possible because I have the method to solve those dynamic stochastic general equilibrium models. It's some kind of technical trick that enables one not just solve any microdynamics, but to find global solution for this specific class of problems in the real business cycle class. This is a third actual application of the same numerical method. The first ones didn't have anything to do with crypto. So this is an example of how this technique can be applied to crypto. So I don't need any fictional non-stochastic steady states or all those self-deceptive tricks that many operators of DSG models need to apply in order to get results to report to their superiors. I stick with global solutions because the method exists that allows me to obtain it relatively simply. This is a model in discrete times, so I cannot call the equilibrium the mean field equilibrium, but this is a stochastic discrete time analog. There is a distribution of pairs, physical wealth and crypto wealth. And based on the initial distribution, agents start reacting and formulating optimal policies, and then this distribution, this joint distribution of those two variables evolves according to a discrete analog of the Fokker-Planck equation. Then one can talk about the ergodic distribution, what happens after many iterations of this procedure. So the main findings are that crypto and fiat assets, fiat currencies, are able of long-term coexistence as soon as one defines heterogeneously rich population. Instead of a representative agent, one needs to model differently rich individuals and also divide this household into parts, one responsible for token acquisitions, the other member responsible for back conversion. These are members that only communicate in the evening. Through the day, they operate independently of each other, taking the earnings or losses of the other of their partners as given. So something that is probably the most interesting and kind of broadly corroborated by anecdotal evidence is the ergodic correlation of conventional and crypto wealth is positive. For instance, if you start with perfectly independent distribution of physical and crypto wealth in the population, so after several periods, you obtain a measure, a distribution that has a positive correlation between physical and crypto wealth. And there is also, so to say, non-adoption region. Has to do with poor individuals, those who don't have enough physical wealth. They don't care about crypto wealth either. So if you are really well off, it's worth your while. If you are poor, then all those Leviathanian effects are not so important for you. What you get from crypto are risks, but not all that much gain. On the other hand, the upper tier in terms of physical wealth, very rich individuals, they over-invest in crypto assets to the detriment of physical investment. Another trade-off to analyze in this quantitative context is if people who have the opportunity to protect their wealth by escaping into the crypto universe, if they have a detrimental aggregate effect on physical investment and on aggregate welfare. Turns out that although the richest really reduce their physical investment, saves the day is the middle class, those people who are not in the non-adoption region, but those who have enough to take a chance. They know that some of the crypto wealth can be lost. In spite of that, they try their luck, and for instance, a large portion of the population only consumes out of converted crypto holding. So they earn something in the physical world, they convert coins back, and they consume out of this conversion proceedings and invest what they earn in the physical world. And in aggregate, this is enough to generate positive increase in aggregate welfare. So if we take as a benchmark world without cryptocurrencies, some world in which they do not exist or not allowed to exist. So what you get in terms of marginal physical wealth density is the red dotted line. You allow crypto assets, then the distribution shifts to the right. Society becomes richer on aggregate, thanks to the middle class, not thanks to the richest, not to the poorest, but golden middle. They collectively are able to compensate for all the escapees on the richest end of the some caveats to the conducted exercise. This model allows Leviathan to impair consumption, but Leviathan doesn't impair investment. If there was some kind of disturbances in terms of bureaucracy or organized crime, whatever, then might all that be different. So this is probably a topic for future research. What happens if there are Leviathanian effects on the production side as well. And the production side is also important from another perspective. It seems to be sensitive to the specification of production function. At the moment, I have the most standard of Douglas neoclassical production, but if one plays with it, then quantitatively certain things start to change. So another area in which further attention is necessary. So that's about all I wanted to tell you today. Thank you for your attention. It was fun to do this work, so maybe it will be a kind of entertaining conclusion of this session.
So thank you, Alexis, for your interesting talk. You were a little bit late, but we are still on time, so I didn't stop you because it was an interesting, let's say, contribution. And I have a question, but maybe there's somebody in the audience that wants to ask questions. Are there any questions from the audience? Or there is one from the attendees. So maybe Paolo, you can let the attendee ask the question.
Yes, he is able to talk.
Maybe let me see chat. No, he can chat, but I'm not. Oh, maybe I can just unmute him. No. Paolo, are you there?
Yes, I mute him, so he's able to talk.
Oh, okay. Now he's able to talk. Perfect, perfect. So please, Marco Patacca from the audience has a question for you.
First of all, thank you for your presentation. It's a very interesting work. And if I understand well, you said that crypto and that fiat currencies can coexist, but that only, in particular, only rich people can invest in crypto. But do you think that the central bank digital currencies can change these things, or, for example, can increase the type of agents that can hold the crypto? Thank you.
Well, I'm not sure that the monetary authority is so far at the moment to make this kind of welfare influencing intervention. They are mainly concerned with handling stable coins at the moment. So an intervention to increase aggregate welfare will perhaps have to do with reducing the Leviathanian burden. For instance, if there are stable coins sponsored by central banks who produce good interoperability with private stable coins, and from them to the whole crypto universe, then probably this will make transition smoother. And this, according at least to the model I experimented with, this might help the middle class because it will reduce the transaction costs and make people less fearful of the possible interventions and burden that complexity might impose on them in the future. So an increase in trust in the society might, in the end, contribute to aggregate productivity, and this will be propitious for the aggregate investment and growth. So at least in the world that I created, this is the probable outcome.
Okay, thank you. I had somehow a similar question. Then I was wondering, apart from the investment, of course, now cryptocurrencies are used mostly for speculative purposes of such a things. But I was curious exactly from the same sentences. So cryptocurrencies and fiat currencies may coexist. And I was wondering exactly whether ideally, in case the trust increases, so maybe with stable coins or maybe with, let's say, central bank digital currencies or whatever, things like that. So if trust increases, you can use somehow your model to say that we can go towards a kind of domination of cryptocurrencies in that sense with respect to fiat. So somehow that crypto trustful, let's say, cryptocurrencies may somehow take the lead over fiat currencies, who knows? And I was just wondering if your model may be used to address this issue. And I was curious to understand whether the pictures in your model were somehow given by data or simulation of the models, or if you have somehow calibrated the parameters to something. So just to understand where those pictures come from exactly.
Well, to start from the end, this is a simulation, yes, from the model. That is, this whole paper is a kind of sociological study. One can say, although theoretically it's a sociological simulation, because I don't.
No, I had somehow guessed that they were simulated, but just want to know if the parameter, you chose the parameter you calibrated somehow, or.
Well, given that pictures are referring to the ergodic case, to the long-term distribution.
Okay, so just with the.
So it doesn't matter where I start.
Okay, 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 I get it. Okay.
Yeah. As regards all those stable coins and other and BSD, or central bank digital currencies, I'm sorry, then all depends, in my view, on whether the creators of those instruments have any social engineering ambitions or not. If they simply want to facilitate transactions, they might gain trust in time and have some kind of positive contribution. But if from the very beginning people have a suspicion that, for example, CBDC is a way of imposing negative interest rates on them, for instance, or tax them additionally in some different way, or control, some kind of intervene in the anonymity, then a flight to the genuine crypto universe will be stronger. There will be no voluntary connectivity with central bank digital currencies. People will simply purchase, I don't know, Monero and risk all the adverse effects that are related to it. And the two parts of the crypto world will stay unconnected. This will probably be some kind of, well, a car with disconnected brakes or disconnected gas pedal.
Okay.
Central bank will push the pedal, but due to the disconnect, the actual traction will be elsewhere.
Okay, thank you, Alexis, and thank you to all the speakers. And we will have a cutoff in 8 minutes. So I just want you to remind that we have a final session with a kind of panel discussion. So I'm just putting in the chat the link to this last session of the conference. And I would also like to thank the organizers of the conference and the Crypto Asset Lab and the University of Milan-Bicocca, as well as the sponsors of this conference, which are CheckSeek, The Rock Trading, and Deloitte FinTech. So thank you to all of you, and I hope to talk to you in the future and see you at the final session of the conference, okay?
Thanks.
If you want to spend a few minutes, because I had thought about having a kind of last question and answer session. We have 5 minutes, so we can wait until they will shut down and maybe just ask each other questions or whatever, okay, if you want. So who wants to stay, we can just wait for them to shut us down. Okay. So Fulvia, are you coming sometime? So I've seen that you are working with Francesco Bartolucci, which is a colleague of mine here in Perugia. So are you coming sometime here to Perugia or?
Sure. I am from Umbria as well, so I come back frequently, I mean, to visit my relatives. So yes, sure, I will also be able, I hope, to meet you at the university or maybe
we probably met already, probably, but I don't remember, but I'm pretty sure that we should have somehow.
Yeah, I studied economics there, and then I moved to Florence, and then I studied also, I work also at the JRC in Ispra as well, and then now I am in Milan, but yes, I hope to meet you as well, but also we can plan a chat, I mean, on this topic as well.
Yes,
I think that now it's not easy, even in Perugia, to get access to the university, no?
No, though the university is open. We still have in-person classes, in presence, not for everybody, but so they are half and half, but the department is open. I just, honestly, with the lockdown, I just moved my PC here at home, and then today I didn't want to move everything back to the university, and then now tomorrow just come back here. So I'm just doing everything here from home, but the department is open.
Oh, okay.
Anyway, I was interested in all of the session. I'm sorry that we had problems that the link to our session was wrong. So this is the reason why we didn't have so many attendees, and I'm sorry for that. I'm sorry that's so we didn't have all these people maybe asking questions and giving suggestions, but they solved the problem just when the session started, but people who tried to connect just at the very beginning couldn't do that. So this might be a problem. Anyway, it was interesting because I work in few of the topics you were addressing. So let's say econometric models, and then with attention measures, and then now I'm dealing with this regime switch and whatever. So I was really happy of somehow going as the moderator of this session of the conference. So
do you know if the presentations will be available as well on the web in the future?
I think so, because they asked us to collect the presentation. I asked for the presentation even in case of some problems with connections, but I believe they will put them on the website. And all the papers are somehow available on the website. So I think that we can, and then maybe with the contacts, we can share ideas and etc. Okay.
Sure. Thanks.
And Alex is also one of the things I'm interested to is exactly whether we can build a kind of new theory of crypto money. So I was really somehow quite personally involved in the topics. So I'm sorry that we had this problem with external peoples due to this technical problem with Eventbrite. It was Eventbrite that had the wrong link somehow. So anyway.
Oh, but maybe people will find the papers on the web, regardless of the broken links.
Yeah, and then everything is recorded. So if people are interested, then they can go on YouTube, I believe. So anyway.
Yes, the video will be on YouTube, so anyone will be able to follow all the presentation after the meeting.
Okay, so good. Okay, so I thank you again, and happy to be here with you, and see you at the final session then. Okay?
Yeah, thank you, and keep in touch for the future. Thanks.
Okay, bye-bye. Bye-bye.
Bye.
Nice meeting you. Bye-bye.